I like to say it this way. At any given time, there are multiple potential buyers for every business. And that's pretty well understood. What's not well understood is that every buyer is going to value that business differently. And they're going to value the business based on factors that are related to how much more valuable they'll be by owning your business. That's what's going to determine what they're willing to pay. That buyer is interested in me for, yeah, they want to know about all the business, but that primary motivation is I want to get that methodology incorporated into my business so I can sell more of my stuff. I'm going to sell his stuff and my stuff, and I'll sell more of it and retain more of them because I'm using this methodology that's proven. So that has real tangible value to me as a buyer.
Welcome to the Raise and Exit podcast. Today, our guest is Steve Little. If you don't know about Steve Little, you will be very glad that you know about him by the end of this podcast. And the reason for it is because he succeeds. And he succeeds for people that are looking to raise capital, sell businesses. And he's gotten taken it from just, a few transactions to almost 6,000 and counting. So on that note, Steve, why don't you introduce yourselves, please, to our listeners and viewers, and give us a bit of a background as to why is it that you have one of the best industry track records that more people should know about.
Thank you, Edgar. I appreciate that a lot. And I'm Steve Little, the Managing Director of Zero Limits Ventures. We are a 15-year-old boutique investment banking firm, principally focused on producing high valuation exits. We developed a methodology that evaluates a company based on 24 different value accelerators. It's a deep dive we do on the company, and we use that to develop a valuation growth plan or valuation growth strategy that we then use to align the value strengths of the company we're representing with the value interests of the highest paying buyers in the market. So by working at both ends of the marketplace, we're able to find the right buyers who are willing and interested and excited about paying the premium on the premium value of the company we're representing. And as we were talking earlier, a byproduct of this is we end up with what I describe as a more harmonious outcome. We end up with buyers and sellers that get along long term, right? And so we don't end up with the fallout and the failure that's experienced by so many other acquisitions out there.
I love what you're saying there, Stephen. Thank you for that introduction. I'm going to probably dig into more of what you do and how you do it throughout this interview with you. But the other piece that I actually would like for you to kind of unpack a little bit more is a theme that as we've been recording and delivering the Raise and Exit podcast has been around like what business are people in? And companies are in the business of building products or services to go and serve their customers.
Yeah.
Those founders or executives are not in the business of raising capital. They're not in the business of transacting a sale. They're not in the business of selling.
Yeah.
Right? And banks are in the business of lending money. Investment banks are typically in the business of going and facilitating a transaction. People think that they're in the business of selling their business. That's not the same thing. And I think this is where what you're going and doing is more of a contrarian lens, because if I understand things correctly, Steve, you're actually encouraging a much earlier in the raise or exit process participation from your firm than maybe the typical 6-month template that is being used. So say a bit more about that. Why does that matter? And why are founders coming too late to when they start raising or selling their business?
Yeah, well, it's a great question, and I really appreciate you bringing it up because it really is a key differentiator in the marketplace. There used to be a time when these things moved along, relatively smoothly. But you've got over $16 trillion of pent-up acquisition demand out there right now. And that's good news for all the business owners that, are exit bound. But it's also creates the environment for a potential feeding frenzy from transaction-oriented bankers that are really not interested in what's best for you or what's best for your life goals or whatever it might be, but they do want to execute transactions. So they can sell that brand and do quite well while you are perhaps not doing as well as you could do. And really, that was sort of a key motivation for me. I think that entrepreneurs represent a sort of a special class of people in the world. I mean, It's not for the faint of heart. It's not easy. Any business owner on this call knows that it's not easy. They don't need me to tell them that, right? But sometimes they forget that they're really sort of special people. And, so they get tied up in the doing and, lose track of the strategy that's available to them in terms of actually achieving what they meant to achieve. I think that entrepreneurs are motivated by something much deeper than money. Whether it's, housing homeless people or feeding starving people or cleaning oceans, whatever the case might be, there's something deep inside these people that motivates them and drives them to do what they're doing. And what happens is that gets lost along the way. It gets buried in the doing, right? And what I want to do is put these people in a position where they can actually have a bigger impact on humanity by increasing the value of what they've built. Right? I want them to get what they deserve for building what they built so that they can take that and then go out and have a big impact on the world, right? And so that's
we're not going to dive into a masterclass from Steve Little, but in the theme of our podcast, which is knowledge transfer to founders and entrepreneurs and business owners, what is a nugget that somebody can kind of go through the thought exercise for themselves that is in the kind of philosophy or approach that you use? How can somebody kind of go and see that? Because I love what you're saying, right? It's like you've lost perspective on why you're going and doing this because there's so much to do. Like I just felt myself right in what you're going and saying, right? I'm a founder of my business. Yeah. We go and do work, and sometimes I'm just like, gosh, like I'm just like trapped in administration versus I want to go and have this impact. So what's something that, and this is me asking on behalf of all the listeners and viewers, right? What's something as a thought exercise that I can go through to get some of that wisdom that you bring in through your services and expertise?
Well, I think that business owners enter the enterprise with a time horizon that's not aligned with what they really want. And so you ask the average founder, or, I'll just reverse it. The average new business owner comes to me and says, I'm getting ready to start a business. What's the first thing I should do? My answer is develop your exit strategy. Now, of course, their response is, well, what the hell are you talking about? I haven't even started. You wanted me to think about the exit. And I said, I'll say that's exactly what I want you to do, because it's the exit that's going to generate the return, right? It's not the cash flow that occurs in between. Right? So the sooner you recognize that what you're working for is that milestone event, then you can put things in the proper order and perspective, in the proper priority, right? So many business owners get into their thing and they start driving and they're building and growing and growing and building and building and growing and growing and building, and they never stop to think about where are they going? What are they actually doing? What are they trying to accomplish, right? And, it becomes a function of KPIs, revenue, earnings, conversion rates, retention rates, all these things that they measure. But how many of them are looking at their business through the lens of value, where they're recognizing that the thing I did today raised the value of my enterprise. It raised the value of what I've invested my life in, right? Not very many. I don't think any, frankly, until they've met people like us. Okay, then
I love what you say there, Steve, because I think there's I've done a lot of work in identifying what are the future drivers of value for organizations in a way that they can grow into them, right? Like they're identified but not realized, right?
Yeah.
And something in what you just went and said, I think, is very critical, because if we look at what goes and gives valuation premium to companies, it's some of the stuff is just like stupid simple.
Yeah.
And what it is you proved that this works.
Right.
Right? That sometimes is the value proposition. Another time is you went and demonstrated that if I keep following this same set of steps, I will generate cash.
Yeah.
Well, you validated that that's the case. I want to buy that process. I'm going to give you some money and be able to go and take it, right? And I think what you're also alluding to, and this is my inference here, is I sometimes wonder whether founders fully understand what is valuable about what they're building versus the abstraction that you talked about, which is the revenue and the cash flows and the EBITDA and the industry multiples. Because I always look at it as this: finance is a layer. Yeah. What is actually happening in reality? So say more about that part from your perspective.
Yeah, no, that's fantastic. Great point, Edgar. So, I like to say it this way. At any given time, there are multiple potential buyers for every business. And that's pretty well understood. What's not well understood is that every buyer is going to value that business differently.
Yes.
And they're going to value the business based on factors that are related to how much more valuable they'll be by owning your business. That's what's going to determine what they're willing to pay. Let me give you a quick example. Right now, let's say I have a company who sells widgets of some kind, right? And there's a buyer out there. One buyer wants to buy me because I have the best customer acquisition, customer growth, customer retention. My methodology beats all others in that market, right? I get customers, I grow customers, I retain customers better than everybody, right?
Yeah.
And everybody knows that, okay? Right? So that's the advantage, right? And so that buyer is interested in me they want to know about all the business, but that primary motivation is I want to get that methodology incorporated into my business so I can sell more of my stuff. I'm going to sell his stuff and my stuff, and I'll sell more of it and retain more of them because I'm using this methodology that's proven. Because that has real tangible value to me as a buyer, right? And I'm going to say, let's just say arbitrarily, that's worth 6 times EBITDA, okay?
Yeah.
Then there's another buyer down the road, or down the Zoom or whatever, right? And maybe they're interested in, yes, they're interested in the whole business, that's true. But their particular interest might be brand or maybe your people or some other aspect than the first case, right? Make it up, doesn't matter what, right? And they go through the same thought process and they say, well, for us, that factor is worth 10 times EBITDA, right? And so their offer is going to be some element that's factoring that in, right? Now, if you as the founder knew nothing more than those two pieces of data, that your customer acquisition methodology was worth, what did I say, 8 times EBITDA, and your brand was worth 10 times EBITDA, where would you invest your next dollar? I hope you'd invest it in brand, okay?
Yeah.
Right? Because you're going to get a higher rate of return.
Oh man, that is you just opened Pandora's box in the work that I go and do. And I'm just boom, right there, timestamp, fork forward a few weeks or months. We're having a whole conversation of brand as a valuation amplifier because I'm not letting this hijack right now, but I'm tempted. But you're also going and talking to, and look, I'm both a fan and sometimes I wince at myself using this term, but we are talking about financial arbitrage.
Yeah.
Right? It's different. People have different value. My initial exposure to it was the whole notion of I roll up companies at 3 to 6 times EBITDA, but because I hit critical mass because I had access to capital, my critical mass premium is 12 times EBITDA. So of course I'm going to go and buy a bunch of companies because I'm minimum doubling my money because I hit critical mass. And then as the S&P 500 has now gone, 14, 15, 16, 18 times EBITDA, damn, if I go public, I get another 50% premium on it, right? And conceptually, it just sounds like minting money, but there's some truth to it. And what you're pointing to is if I can kind of go and put it, it's the sequencing of finding the buyers that see value because they're in a position to actually realize that value.
Right, exactly.
And I like where I think this is kind of going as a topic to our listeners is do you know who you can add value to? That's what I'm hearing from you, Steve.
That's
and I don't think enough do.
So first of all, 100%. Do you know? So this is why we evaluate 24 factors. Do you know
say more about that, because you said something when we had a prep call. You said you have 24 factors. Some are drivers, but other accelerators. And I'm curious about this accelerator piece that is here. Say more about that.
Okay, so think of value drivers as things that exist in the business that could be constraining value, right? So
interesting. That's the total opposite of how I would have related to it.
Yeah. So think of it like you don't have a really good sales methodology, if we use that one, right? That's a constraint. Think about your understanding of your position in your market, right? Mm-hmm. It's a huge constraint. Because when I say, do you understand your position in the market, what I'm really saying is, do you know what your market is doing? Is it growing or contracting? Are you growing and contracting faster or slower than your market's growing or contracting? Mm-hmm. How are your competitors behaving in that market? If you don't know all of that, you don't know your market, right? And
Yeah.
that makes it a constraint, okay? Because you have to know that in order to optimize that value driver in your business, okay? So that's what drivers are about. Value accelerators are usually outside of those things. So a value accelerator would be like a data strategy, right? Are you compiling data out of the regular interactions that you do in your business that would be useful as a separate entity? That's a data strategy accelerator. There could
Yeah.
be like an impact mission is a big accelerator, right? When I say impact mission, I don't mean a bolt-on charity. I mean, do you have a mission that becomes a element of your brand identity, right? Is it something people say, like Patagonia? When you think Patagonia, you think green. Why? Because that's their mission, okay? Right?
Yeah. Yeah.
So, and that's a value driver, right? Other outdoor products companies that don't have that value driver or value accelerator don't realize that value gain, right? And so there are others, but there's 6 of them, right? And so you have
That's
these
helpful.
opportunities, all right? And
Yeah.
you can
And some
pull
of those
these
are
levers.
Sorry, go ahead, Steve.
No, no. Well, you can pull these levers any way you want, when you want, right? You can decide when you're investing in value and when you're not investing in value. And I tell founders, look, it's legitimate to invest in something that's not driving value. It's not an illegitimate expense, but you just want to know when you are and when you are not driving value.
Yeah. Oh, it's man, that is. There's so many layers in what you just said there, Steve.
Yeah.
I just got to go and say that right now. Like, I hope this starts like a whole dialogue amongst people there. And I want to kind of build on what you're going and saying here, because I love that notion of it's a constraint, right? Like, a lot of people go and say drivers, like, oh, if these are in here, like, it's what's allowing you to drive. What you're saying is you're already driving, and you got something that has your car in neutral, or you have a block of stone in front of you, and you're wondering why your tires are screeching.
Yeah. Well, you got a
Right?
cloud spark plug or, something
Yeah.
else. I mean,
Yeah.
so it's not doing what it could be doing. So it's
Oh, it's
creating
so
constraint.
good. That's
Yeah.
so good. And I think it's that objectivity that you're bringing, which goes back to your contrarian take on investment banking. You're here not to facilitate a transaction. You're here to facilitate uncovering value.
It comes down to this. Better businesses are worth more. So I'm going to build a better business. I'm going to help
Yeah.
my founders build a better business. It'll be worth more in the market.
So how do people manage their expectations around this? Because I see the trap of companies coming in, okay, I'm ready to raise, I'm ready to sell, and they enter, what they want to be a 3-week process, but it's typically a 6 to 12-month process, right? So if we kind of look at that from that point of view, what can a founder, executive, or an owner of a business kind of have to go and do to prepare themselves and almost call one on themselves in managing expectations of making sure that the raise or the exit happens?
Yeah. Well, I think it goes back to the first point I was making is I think they need to have the right mindset about what the right trajectory is, right? And there are numbers. I have charts. I've studied 4,100 companies, and they're all the data and out of the MIT database. I know the numbers on this, and generally, it surprises founders to hear how early they should be thinking about this, right? Most founders, they're just barely getting started at 2 years, right? Well,
Yeah.
the data says you really ought to be thinking about touching the market in 2 years, right? Like you
So
should
what
be
you're
out.
talking about is getting signal, right?
Yes.
You want to
Yeah.
be able to figure out which way the wind is blowing, because like we go and look, like valuation isn't just based off of what your company does. Valuation is based on what your peers or competitors are doing, what your customers are doing. And as you went and said earlier, there's trillions of dollars in capital. Those people need to do something with that money rather than having it sit in T-bills.
Yeah, it's exactly right. It's so fascinating. There's a quote that I have in my regular presentation that says, Evernote wasn't worth $1 billion because it was worth $1 billion. It was worth $1 billion because it was going to be worth $100 billion, right?
Oh, God, right there. If you're a founder listening to this, go and find out how much you can be worth if your idea is realized. Because I talk to people and they're like, oh, we're worth $100 million or we're worth $500 million. I'm like, what's your revenues? And they're like, 600,000. I'm like, hold on a moment.
Yeah, right.
You are aspiring to that, right? But what are the circumstances that are, I think are there? I think are very critical, and that is so good. I want to go and shift a little bit on the topic side as well, kind of going more into the theme of our conversation here. And what I want to take a look at is the notion of the ability for the buyer to actually buy and integrate you. You talked about how the fact that you're worth more to different people. How can founders recognize in themselves before they start selling themselves that they can actually be integrated? I'll give you an example. I'm working with a company right now. They have 3 CRMs because it's been a bunch of bolt-ons. They never integrated. And it's just like the left hand doesn't know what the right hand is doing, and the imaginary hand is doing something else, right? So go ahead.
So I would see that as a constraint. That's a constraint to value, right? And so our recommendation would be you got to clean that up right now, right? I don't care how you do it. I don't care which one you pick, but don't have 3 of them. That's a constraint to value. It's making it harder. Fundamental rule here. The higher the risk of ownership, the lower the value. The lower the risk of ownership, the higher the value. So if
And
you
by
do
ownership, you mean the transition of ownership.
Yeah.
Yeah.
I mean, if I'm a buyer, you got to mitigate risk for me, right? The more risk mitigation you've taken on, the more I'll pay. The less mitigation risk, the more less I'll pay. That's simple, right? Same thing in investing. Same thing on the venture side. What the venture investor is doing is mitigating risk, okay? Right? So and that's the same story, right? You're doing the same things. It's just, is it all of it or is it some of it? Right?
I think that is so interesting what you're kind of pointing to, because if I'm kind of starting to better grasp what you're going and talking about, like removing those elements, right? Injecting cash into the business could actually be something that is a driver because of the fact that it is removing the risk of essentially cash flow management that the organization has. And then what you're also alluding to is something I'm a very strong believer in, but it gets me dirty looks at times, which is you want to make sure, if at all possible, that your company is sellable at any given time.
Yeah.
Right? And it may not be there like from day one, but at a certain point, you need to set the business up to be sellable at any given time. So I'd love your take on that.
Yeah, no, I know people. They give me the same dirty looks, Edgar. I mean, when you say to somebody, "Build it to sell," people are like, "Oh no, that's short timers thinking." It's like, no, it's not. It's strategic thinking. It's smart, okay? Because there is going to be an exit. Just get over it. It's going to happen. Whether you sell it, whether you take it public, whether you give it to your kids, or whether you keel over dead at your desk, there's going to be an exit. And the point is, you're investing your life into this thing. It's everything. It's all you do each and every day. It's all you think about. It's the thing you take home with you. It's the thing that's there in the morning. It's the thing you have your coffee for. All of those things are there and they're real, right? And there is going to be an exit. And so what you want is for the value of this thing you're investing your life into to be as high as possible at that event, whenever that event occurs. I'm not telling people you have to sell in a certain amount of time. I am telling them there's going to be a time, right?
So
and the more prepared
sellable.
you are, the more prepared you are, the better off you'll be.
No, it's totally fine. Because what you're essentially saying is like being sellable is a strategic lever. What it also goes and does, in kind of what I'm hearing both from you and from conversations I've had, with peers and industry, if you are sellable, then the impairments on your business that would reduce your value have a much higher likelihood to be addressed.
Yeah, no, exactly. I mean, it compounds. It compounds. I have another chart that's in my presentation where I described the environment when I was building software companies. So I've been blessed with a lot of success. I've built 6 companies and took them each to 9-figure exits. And back then, the probability of a successful exit occurred at an extremely slow pace. So you weren't even on the horizon for an exit before 10 years, right? Because it took you 2 years to build software back then. I mean, it was
Yeah.
all Perl scripts and stuff. Then it took you 2 years of testing and beta testing. And then it took you 2 years for proof. Then it took you 2 years to make a little bit of money. Then it took you 2 years to reach some dimension of profitability or something that might look like profitability, even though it isn't. Then you'd be ready. And then there was this little bubble, like literally a tiny little bubble of probability that you could sell. And if you didn't take advantage of it, you were in for the long haul. You're going to die at your desk kind of thing,
Yeah.
right? You were entering what I call the valley of death, okay? Right? Which is the only way out of that valley is an extremely large infusion of cash, right? Okay? So that was the way things were when I came along, right? Before the dot-com thing, to put ages on that, right? Well, after dot-com, what happened was there was this probability of success bubble that occurred very early, and it was very large, very high probability of success very early, like between 2 and 4 years. Now, how many founders do you know that are thinking about exiting in 2 to 4 years? Not very many.
I would say there
right?
may be a small subset of the current AI boom that is happening, right? And we've seen evidence of it. Like you look at what happened with Windsurf, right? Young organization. You go and take a look at some of these other like 0 to 100 million in revenue in a year. They're probably in that at least targetable state, right? So
Yeah, they are. So what's happened is, so back in 2015, when these, so I remember I did all the analysis, 4,100 companies. Back in 2015, this big bubble occurred, and it stayed there. It sustained for the remainder of time. And so basically it said, the highest probability of success for you as a founder is between 2 and 4 years. So you should really be targeting an exit in 2 to 4 years. Well, okay, if it takes 9 to 12 months to sell, that means I need to get started like my first year.
And
right?
just to be clear, it takes 2 to 4 years to sell from when you start, not from when you started the company.
Yeah, no, when you started the company.
Oh, wow. So you're saying if I start a company in 2025, I actually need to give consideration that I might be able to sell this thing from zero as early as 2027 to 2029, or at least be prepared to do so.
That's what the data says.
And is that sector agnostic, or are we talking AI boom? Because I'm feeling confronted right now.
No. See, the AI boom slid it even. I wish I could show you the chart. The AI boom slid it even closer. It's now 6 months to 18 months.
Oof.
Look at how
I feel over the hill, Steve. I feel over the hill, Steve. We're in year 7.
All right. So now you know why this is an interesting thing, because most people don't think there, right? And I'm not saying they should.
Gosh.
I'm just saying that's where the data says they should, right?
Steve, my heart's racing. You just killed my last question, which was going to be what's the most counterintuitive risk factor. I think the most counterintuitive risk factor is thinking that you need a lot of time to build a company that is sellable.
No,
and you're going and telling me, Edgar, like reset your assumptions.
Yeah. Well, here's the other thing. Think about what this does to your exit strategy. Now, when I sit down with founders and we talk about an exit strategy, everybody gets focused on what? The exit.
Yeah.
What I point out is an exit strategy is not about the exit. It's about the strategy. You need to understand what you're doing and why you're doing it, right? And it's okay to recognize that, look, in my market, with what I'm doing, my exit strategy should be to move it to the next owner in 2 to 4 years. Now, I want to be I want to point something out. I said that intentionally that way. I didn't say exit in 2 to 4 years. I said move it to the next owner in 2 to 4 years. And here's why. The game is not over when you sell. You're just there to get the thing started. That's your point. That is your dream spot. That is what you're good at. I used to go to our investors after 3 years and say, I'm out. I'm not your guy anymore. We're doing $140 million in revenue. I'm not the guy to run a $200 million company. You need somebody else for that job. Hire my replacement. Right? Because I could get, 122 million for that company if I sold it now. If I stayed on, I'd have run it into the ground and gotten 40 million, right? So, right? I knew my limitations. And I recognized that for me, I'm going to sell 100% of the company and take 85% out. I'm going to leave 15% in. And 2 years from now, when that next guy steps up and says, I'm not your guy anymore, you need the guy that's going to take it to $1 billion, my 15% is maybe worth more than the 100 million I took out 2 years earlier.
Steve,
That's the game of entrepreneurship.
I am I am having a lot of stuff recalibrated in my head. I'm going to be digesting this conversation for months. In fact, like I'll be digesting it overnight, but like I mean, it's not going to go away. Um, I I could keep this going, Steve, and we've agreed. We're going to have an aside. I think we're going to come back. We're going to talk about brand as an amplifier because man, you just touched upon one of my favorite subjects that I think is really misunderstood in the world. On this note, I want to thank you for joining us today. And we will put links to Steve and his chart that he talks about with the launch of this podcast. And thank you for joining us, Steve. Until next time.
Hey, thank you, man. I appreciate you.
I value my guests for all the variety of things that we as listeners get to hear from them, the wisdom that they go and pass on. But this session with Steve Little and my conversations with him just really had me go and reevaluate my assumptions on growth and scaling, and especially around going and scaling companies in industries and practices that are not known for it. And to hear from him how he and his team have just gone and done this, day in, day out with so many different organizations, just put me into an awkward position for myself because I really have to go and evaluate, like for my own company, like, do I give myself permission to even think about how crazy this could be? And I invite you to go and listen or re-listen to what Steve goes and says and what he's kind of alluding to. What could your company look like if you went and put it onto an accelerated growth? Is it worth the trade-offs? Is it possible? What would it take to do so? What would be the payoff for you, your customers, your employees, your partners, whoever heck else is involved? And you may not go and execute on it, but I think it's a very worthwhile thought exercise to go and have of what is the potential for your business that's there. I recently went and read something about, risk mitigation and, considering yourself for all of the downside elements that are there. But what if things go right? What if things go well? And I don't know if we give ourselves enough permission and time to go and consider that. And I think this is what Steve has gone and done with his organization. So here's an invitation for you to just pause and go and take a look. What if it really worked out? Like, I mean better than I thought it could work out. And even better than I thought it could work out. What does your business look like? How would you think about it differently? How would you promote it differently to your customers, to potential employees, to potential investors, or people who would go and acquire your business? So that's kind of my uncomfortable question I'd like to leave with you today. Have a good one. Till next time.